Welcome, everybody. This is Jeff Dohrmann. And today our podcast is with John Atwater, who's the co-founder and managing partner of Prime Finance. And as all of you know, the commercial real estate markets are composed of both debt and equity. And debt comprises a much larger portion of the capital markets for real estate than does equity. And so what happens in the debt markets is really important, both for the people who borrow money to leverage their investments and for the people who commit capital to lend money in the marketplace. And there's been a lot of disruption happening lately. So we thought it would be appropriate to talk to somebody who really knew something about it, about these issues and what their implications are. So John, welcome to the podcast. And could you tell us just a little bit about Prime Finance?
Sure, absolutely, Jeffrey, and thank you for having me on the podcast. Prime Finance is an established commercial real estate manager, provider of credit with a 16-year track record, $13 billion of AUM, positions in approximately 9,000 properties today through our landing platform. We have in-house investment sourcing and asset management, and we participate in the market really in three ways. We are one of the larger bridge lenders, so essentially giving bank loans to commercial real estate assets across the United States, first mortgage loans, floating rate, usually with a draw for some kind of a business plan, very similar to a bank. We are also one of the largest players in the CMBS B-piece investing business, which is a super exciting area right now today, as we'll talk about later. And then finally, we have a large special situations business, which is similar in some ways to the bridge business. It's just higher octane, more structured, more bespoke, higher returning, and it's a great time, obviously, to be in that business today.
And I've been told, John, that you started your career in real estate during the S&L crisis over 35 years ago. How did that early experience shape your approach to real estate investing and led you to the founding of Prime Finance?
In many ways, I was lucky to, really start my career in my 20s during the savings and loan crisis. It was a period where virtually every real estate asset was deeply troubled, if not bankrupt, in the United States. And I had the opportunity to see every problem you can conceivably see, from title issues to construction issues to vacant buildings. It was literally a time when buildings were stripped for their copper and their appliances and abandoned by the thousands. So it was a remarkable time to get an education. And I was lucky to be learning then and not have the baggage of a large existing portfolio. This has deeply impacted how I've approached the business ever since, in terms of the need for sustainable cash flow, and it's very similar in some ways to the current period, where there was a giant provider of capital. In that case, the savings and loans. Today, it's the smaller community banks and regional banks who have suddenly and very rapidly withdrawn from the market, creating real opportunity for the people that are positioned well.
Well, let's talk about that for a minute. Size that up for me a little bit. What percentage of the commercial real estate lending market has been dominated by the regional and community banks? And why in the world are they pulling back? Why now?
So the regional community banks were, in fact, the largest suppliers of capital in the commercial real estate lending business. They had slightly over a third of the market, representing, over $1 trillion of capital provided, and they've suddenly pulled back. The reason they've really pulled back, it has to do with regulations. So larger banks, typically, the top 25 banks, they're in pretty good shape. So while they're pulling back some, they're well capitalized and they're quite healthy. the smaller banks had a different regulatory, more flexible, easier regulatory setup that caused all kinds of issues that you saw with Signature Bank and others. And so the regulators have decided that they really need to be subject to the same kind of regulatory regime of the larger banks and have largely shut down their commercial real estate lending, entirely.
So what kind of opportunity is the pullback of regional community banks creating for private lenders like Prime?
So as you can imagine, there's really a gaping hole in the capital markets, and the opportunity can be summed up that you really can have equity-like returns with debt risk here. So if you're going to get a little more specific about that, depending on where exactly you're playing in the capital stack, you can earn returns of 10 to sometimes over 20%, returns depending on how much risk you want to take. So
Okay,
it's a
that would
lot
be,
of returns are in the mid-teens and squarely where a lot of equity players play.
do you have to leverage your positions to get those returns?
Um, so again, it depends on where you play in the capital stack, but typically there is back leverage that you have, and we'll get in that as we talk about what you need to make this business go. But typically you do have some back leverage. There are other areas though where you can get those kind of returns without any explicit leverage. So, for example, in CMBS, there's no explicit leverage. There's obviously implicit leverage of people higher up than you in the capital stack, but there's no debt involved. We don't borrow to participate in those markets and earn very attractive rates of return.
So the kinds of returns you're describing are what I would call in today's marketplace better than equity returns. What kind of risk do you have to take in order to generate those kind of returns right now?
Well, it's a good point. We see hundreds and hundreds and hundreds of transactions, and often we would prefer to be in the debt position vis-a-vis absolute returns, not so much risk-adjusted returns, but absolute returns. What you're seeing is in the risk sense, what you're really seeing is some of the best credit metrics in my career. So, for example, in the CMBS market, the average LTV is order of magnitude in the 50 to 55%. Debt yields are 12 to 14%. And these are for fully stabilized, highly institutional properties with typically long-term leases. So it's really remarkable if you look at it. In some ways, you could say that returns like this for the risk that we're taking shouldn't exist.
Now you've mentioned just now that credit metrics and pricing in today's market are at levels that are rarely seen in your career. Can you explain how this capital imbalance is creating attractive risk-adjusted returns for well-positioned lenders?
Um, well, I think if someone says there's a capital imbalance, really, two things have to exist. One is very, very high levels of credit, just as we've talked about. And the second is very, very high levels of return. Without those two things, there really isn't a capital imbalance. So people can describe it, but that's what needs to happen. To access these types of returns, you need a player who's very well positioned. So as you probably there are lots of people are trying to get into the debt space today. What the new entrants will lack, and they'll find challenging, this isn't like an equity market. This is much more of a branded business. So the first thing that you really need to access these opportunities is access to the investment. So, new entrants are going to find it difficult to do that. So, for example, in our business, well over 50% of our aggregate transactions are to people that we have existing relationships with, and we've done investment after investment after investment, repeat borrowers, in essence. And, they prefer to transact with us for all kinds of reasons, and that's a massive competitive advantage. Uh, Another really big competitive advantage that's important and often missed is what happens after you make the loan. So from the investor perspective, often you need some kind of back leverage, very much like a bank, right? And so a new entrant might have access to one or two players with, typically mark-to-market financing. The more established players do not have mark-to-market financing. They have term-matched financing, and they have access to, 8, 9, 10, 15 different players. In the end, players like Prime have access to lower cost of capital. And you can imagine what that means in terms of having higher returns and less risk. The third thing that you really need to be successful in this business is in-house asset management. Experience that can deal with the issues that come along and capitalize on the opportunities that come along within any given loan. It's a hard package to put together entirely. And so, of the many people that are, coming into the market, we don't actually see them as very much competition thus far.
So where specifically in the markets do you see the greatest opportunity right now? And I'm talking about geographically, by property type, by position, the capital structure. Where do you see the opportunity to make the most money with the least risk?
Um, so the opportunity is really, throughout the debt markets, and you can kind of pick what you want. Obviously, there's a lot of trouble in the office building space. There are good opportunities in there, but there's more trouble than there is opportunities, and you really have to know the difference. In the immediate period, the place that's most immediately filling the gap in the marketplace is the CMBS market. It's a safety valve. It's really the role that it played in the saving and loans crisis. That's when it got going, and that's when it got going and filled that gap, and is doing exactly the same thing today. But in many respects, it's across product types. It's across um, different kind of investment instruments. And it's an exciting period. To some degree, the investor needs to pick what kinds of returns and duration, they're interested in, because each of these have slightly different financial outcomes. So, are you interested in a little longer duration, a little more risk, a little longer duration, a little less risk, shorter duration, et cetera?
You talked a minute about new players coming into the market, and according to our RIQ database, there are at least 212 different real estate debt offerings currently in the market, along with more than 800 debt offerings that closed at some point over the past 3 years, which represents 73% of all the debt funds that have come to market since we first started tracking fund offerings in 1996. With all these new debt platforms seeking to raise capital, from an investor standpoint, what should investors be concerned about? What should they be looking at? Where should they be focusing? Should they be avoiding and watching out for?
So obviously, you can raise money for debt, right? And so, managers are interested in raising money, and a lot of equity players are suddenly, saying, well, debt looks pretty good, right? Um, what you should really focus on the investor is the competitive advantages. And, you can really see the people that have competitive advantages are earning higher returns with less risk. I would say the number one thing to look at is to make sure to not invest in folks that have only one or two back leverage opportunities and those are mark to market. That is, a toxic combination here. And that's the number one thing. But again, if you have access to the repeat customers, you've done it for years and years and years. You're very much like a bank to access on the transactions. And then what you do, after the fact, is really important. And that's what, drives, a lot of excess return.
From what we can see, it seems like we're kind of bouncing along the bottom and maybe we've reached the worst in terms of value write-downs. But that leaves a lot of borrowers in a position of having assets that are either underwater or close to being underwater. So they're scrambling around looking for refinance capital or other ways out. What about the borrowers with all this new capital in the marketplace? What should they be wary about when seeking to tap into this new host of potential private market lenders?
Well, if you think about it from the borrower standpoint, what they really have faced is the largest and the fastest increase in interest rates, certainly in my career, and maybe ever, maybe ever. And so, rates in a little over a year went from close to zero to just over 5%. And what that does to the borrower is obviously higher discount rate means that you have, a lower value right off the bat. And so, if you're a borrower with a variable rate loan, that's been painful. The bigger issue really comes at maturity. At that moment, the loans just don't size like they did when interest rates were zero. And so the borrower at that moment is faced with a choice. He can either give the loan back to the lender, give the property back to the lender, or he can put some more money into the property and live for another day, resize the loan. In fact, we're seeing probably over 90% of our transactions involve cash in refinancings. So obviously you have some acquisitions and you have some refinancing. Most of the refinancing involves cash in
And where's that
to
cash coming
resize.
from?
It's a fund and they have the money. It's a wealthy family. They bring in outside investors. There's all kinds of ways that they get money. I would say a lot of quality assets that are going back to lenders, which isn't a big number, but those that are people that don't have access, they're weaker borrowers that don't have access to capital.
Now, with rates higher than they were traditionally, Treasury and bond yields also are higher. Why shouldn't investors just plow back into the traditional fixed income markets rather than take on additional risks associated with real estate credit right now?
Well, it's an interesting question, and basically what you can earn in the real estate markets is much higher spreads. Think about this: you can get investment grade type risk and earn mid-teens returns. So that's really interesting,
Do you
right?
think,
And
do you think the spreads are overemphasizing the risk that is involved, or how much risk do you think real estate lending is over investing in, say, investment grade bonds?
my opinion is that the spreads are higher than the risk, particularly at the 50-55% LTV. And it's really a function of not having enough capital in the market. The gap is huge. So I think that the gap will run for another year and a half, maybe 2 years, until it stabilizes. Capitalism hates a vacuum, so it will in fact fill, over time. But this one is going to go for a while. And if you look at the underlying fundamentals of the assets, there's a lot of good assets out there. With inflation and other things and the increase in replacement cost, cash flows will catch up to the rise in interest rates. It'll just take some time. And borrowers are seeing that. So borrowers that can typically are recapitalizing and playing for another day.
But there are some risks associated with commercial real estate lending, and how can you as a lender mitigate some of those risks, or how can any lender mitigate some of those risks?
Well, it's basic credit analysis, right? And from our standpoint, we're always looking at LTV. We're looking at quality of the assets. And first and most importantly, we're looking at debt yield, i.e., cash flow to our position, and sustain, how high is that cash flow compared to our position, and how sustainable is it? If you can get enough cash flow running through the system, you'll be just fine as a lender.
Now, you mentioned some of the constraints or the problems that some of the new lenders moving into the market may be facing. What are some of the mistakes you see some of the other lenders rushing into the market right now making right now?
Well, the biggest thing is how they back lever themselves. So many of them don't understand exactly how that works, and they think that the business is really just about making the loan upfront, and not what happens after the fact. So they enter into, quite unfavorable financing arrangements if they can get it at all. And if they can get it at all, remember there's only, most of these financing arrangements are with balance sheets, and there's a limited amount of balance sheets. These are also lenders, and they're picking and choosing who exactly they want to do business with. So, if they think that you're a better credit player, you have many, many, many options of who to finance with. If you're a new entrant or thought of as not a good credit underwriter, your world is really tough in terms of getting financing. It's a slimmer set of opportunities. So that's the biggest thing. I will say that many of them also make a mistake, in my opinion, of outsourcing the asset management. And it's such an important skill, and it's such an important way to know your assets, so that when problems or opportunities come up, you can be on it in a day or two, as opposed to with the outsourced servicers waiting months and months and months until you even know what's going on.
Now, the Fed recently implemented three successive rate cuts, and um, questionable as to whether there's going to be more to come next year. But what impact is all of this having on the opportunities you've been describing? Because you've been describing a historically high, at least in the recent 30-year period, interest rate environment. Now they're coming down a little bit. How has that changed the opportunities you've been describing?
Yeah, it's a great question. And uh when rates went up so quickly, the markets sort of froze, and there was very few transactions for maybe 9 months, or a year. But the pressure builds and builds. You have to have a certain amount of financing that goes on. And today, the market, while probably not fully loosened up, is largely functioning, in a good place. The dominant interest rate in real estate is the 10-year. So if you follow the 10-year, the short-term rates have come down a little bit, but the 10-year really hasn't changed at all. If you think about this from a borrower's perspective, a 4% 10-year is painful, but life goes on, and things can function. At 4.5, about where we are today, it's much tougher on the borrower. Probably the stronger borrowers can figure it out, and it's not, it's really painful, but they'll work through it in some way. If we get to 5%, it's really difficult for virtually everybody. And you're going to see a lot more trouble in the market in those ranges, given how balance sheets are structured today. The If you're looking out at rates, and thinking about where rates are going to go and what exactly is the neutral rate, which is the big question,
Right.
right? And that's what the Fed always is looking for. What's the neutral rate? What neither makes the economy expand too fast, or slows it down too much? We believe at Prime that the rates are somewhere about where they should be. There might be a few more, in the short run, they might bring them down a little bit more. But we believe for some time that the 10-year probably bounces maybe at a low of 3.5 to 4.5, type of type of areas, with the risk being slightly more to the downside, i.e., that rates go up a little higher than we think, than to the upside. If we think that there's a lot of pressures out there, somewhat exacerbated by the new administration, you know, housing pressures, et cetera. And we think that there's a little more risk to the downside than the upside.
I mentioned earlier that we seem to be bouncing along the bottom. And the reason I say that is we just did a podcast with Garrett Zadolczek at IDR about the Odyssey funds. And he was saying that finally, after a very prolonged period of time, many, many quarters, um, assets are trading by Odyssey funds above carrying value. For many, many decades, not decades, many quarters, they've been trading, below carrying value. That would suggest that we're starting to come into balance. Is that your view, or do you see things differently?
I think the market is coming into equilibrium to some degree. I don't think it's fully there, but I don't think that there's very many people that are thinking that interest rates are going to go back to zero or at the very, very low amounts. And so they're slowly adjusting. A lot of people have taken their write downs. You're also, the thing about a little more inflation is that ultimately you're going to see some cash flow growth out of this as replacement costs go up and whatnot. You are starting to see some green shoots along those lines in assets, across the country. And I wouldn't quite call it a trend yet, as that, there's still a lot of supply being delivered that came out of the ground a couple of years ago. But by this time next year, the supply really stops in virtually, all categories. And, you're going to see some good cash flow growth. So I would suspect that outside of some large unexpected event, that we are somewhere around the bottom,
And
maybe even off the bottom a little bit.
you've talked about cash in loans. We're seeing a trend where some borrowers are recapping and paying down loans rather than returning keys to the lenders. From your perspective, what's really driving this behavior and how does it impact lending strategies?
Well, from a lender, it's phenomenal. I mean, you always like fresh cash coming in. Clearly, if you're going to do a workout, the borrower needs to come with some cash. Otherwise, the lender is supposed to take the asset back. And so, it's a very good trend from a lender's perspective. Really, what the I believe what the borrower is thinking is that there's still supply coming out of the ground, and that you will have a pretty good cash flow growth in the future. Uh, I think there's also a lot of borrowers that are not looking to crystallize the loss. And so, investors should pay a little bit of attention to that, right? Because, no one wants to go to their investor and say, "Oh, I definitely lost money here."
And yet sometimes that's the answer. How do you avoid falling victim to this sunk cost fallacy? I put all this money in, I can't let it go. I got to keep investing in it. In other words, how should a borrower determine when to hold them, when to recapitalize, or when to fold them, when to give back the keys?
It really comes down to quality of the assets. So replacement cost across the board has gone up for almost every asset type. If you have a strong, high quality asset with some barriers to entry, and the new money is going in at vastly below replacement cost, typically that's one to really look at keeping.
So let's say I'm a borrower and I'm looking for a recapitalization partner. What are some of the issues that I should be considering?
I think the main thing is, in the before this period, if you were a big borrower, you typically wanted a relationship with a bank. So, you went to Wells Fargo or JP Morgan or whoever was your relationship lender. Today, the world is getting debanked, and we are in essence the new bank. You want a relationship with a player like us. And as you're picking that player, there's a number of different mindsets that you can really see. And you want a player who wants you as the borrower to be successful. That doesn't mean that the lender won't foreclose or do anything, do any of the other activities. But typically, you're looking for someone that wants it to be a win-win. There's a whole variety of mindsets out there, as you know. There's many loan-to-own players. There's many equity players that, fundamentally really are equity players. And they look at the world that way and they really want the equity. There's a lot of lenders, people like us, that really want our borrowers to be successful and work for their success, not only in the terms of the transaction that we do, but the asset management that we do after the fact.
Now, non-bank lenders like yourself are by definition not regulated like banks are. And of course, those regulations are the result of many tragedies that have occurred over many, many decades, and effort to try to correct them to protect the public. Um, what should an investor be thinking about when they're investing money with a non-bank lender like yourself, to make sure that you don't get overextended, that you don't end up doing something silly like you know borrowing short and lending long, all the things that have happened in the past.
Right.
How do they know that your balance sheet is still strong and capable of sustaining losses if it has to take them?
So the lenders that have had a long track record, you really know how they capitalize themselves and how they work. And so, your borrowing short and lending long is really the mark to market issue. So many issues come from that issue. Um, Furthermore, in the debt itself, you should really look, and this is a big point for investors, at the cost of capital. So the people that are viewed as good, solid, long-term credit players, they pay a lower cost of capital than their competitors, and you can really prove this. If you have a lower cost of capital, like Prime does, uh, you, we can earn we can earn higher rates of return than our competitors at lower risk. And so as the risk goes down, it's a virtuous circle that the risk is lower, and so the lenders learn this and they give you even a lower cost of capital, so you can take less risk and earn more returns. But the cost of capital is just a really important aspect. And then match term financing, matching your assets and liabilities is a big deal.
And how do you make sure that you don't fall into the trap of getting out of whack in those areas?
We have at Prime, we have extensive processes to look at this, frequently, and just make sure that we're match termed, our assets and liabilities are matched. We also have an extensive process looking at our portfolio. We have a very large portfolio, and trying to make sure that we don't have a bunch of correlated risks that aren't evident across the portfolio. So, how exactly you manage the portfolio is also very, very, very important.
And I believe you've been quoted as saying in the past that firms with the best credit skills don't just survive, they dominate. So more specifically, what kind of credit skills, portfolio
So,
diversity and asset management capabilities distinguish the dominant firms in today's environment?
so it's so important, and this is also a giant point here. If over cycles you have good credit. But what happens when the market's going up, it's hard to see credit skills, right? Because, typically the people that are taking a little more risk are earning, more return. And then they more than give it all back when the market goes down. And so, you need to look over cycles at what happens. There isn't typically enough return in this to make up for huge losses in capital. over time. So it's really important that you have a philosophy of, don't lose money. It's the number one rule, and it's the number two rule, and it's the number three rule. Don't lose money, on the loan. And then in addition to that, you get a reputation. It's just what I was talking about before with the virtuous cycle. The cost of your capital, comes down, 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 and you can take less risk than your competitors and earn higher rates of return. So I mean that's a big thing to understand here. That I take less risk than my competitors and earn a much higher rate of return. And so that, over time and through cycles ends up just dominating.
Now, you mentioned loan to own as a strategy that some people are pursuing. You're not. Why not?
Well, the thing about loan to own is borrowers don't really want to do business with you, and we're looking for repeat relationships. Do things with people over and over and over again. And I mean, the truth is, we're doing it because we earn a little higher spread, from those folks. Um, but loan to own strategy is actually a lot of work, and it's not a scalable type business. So in terms of pure business, we're looking to do a lot of transactions, be a branded lender, not a relatively narrow lender, trying to make one or two or five, tremendously good deals. But we're trying to do, hundreds and hundreds of transactions and build powerful portfolios.
Okay. Final question would be, look into the future. What advice would you give to investors navigating the complex and shifting commercial real estate market? What critical factors should they consider to capitalize on today's opportunities most effectively?
So I think that investors should really look intensely at how dependent their returns are to the terminal cap rate versus the cash flow along the way. So, in the past maybe 10 years, I think that there's been an overemphasis on terminal cap rate. And as interest rates went up, that caused a lot of issues for investors. I think today the terminal cap rate is a highly speculative number. We've talked about interest rates, which is, deeply impacts that. Probably we're somewhere in the range of stability, but there's a lot of risks around it today. So what I would encourage investors to do is spend a lot more time looking at the cash flow that they get from their investments over time. And if you work out all the math, if you get a lot of cash flow, it greatly diminishes the risk that the terminal cap rate won't be there when you get to that moment.
Right. Thanks, John. Really appreciate you taking time to spend with us today.
Thank you.
Okay. That's good.